Hereby I open this academic ceremony in which Alexander Carlo will defend the academic thesis, institutional investment and ownership of real assets. May I invite you to present a summary of your study and the conclusions of your thesis.
Dear Pro-Rector, dear members of the Defense Committee, dear colleagues, dear friends, dear family, I am pleased to present to you an overview of the main findings of my dissertation, titled Institutional Investments and Ownership of Real Assets. Now, before I start, I'm going to start with one figure. That's 20 years. So 20 years is the amount of time that the average person is supposed to spend in retirement. With an average life expectancy of approximately 80 years, that's a quarter of your life that you're not part of the working force, you don't have an income, and your financial well-being is fully dependent on the savings accumulated during your working life. Now, when we talk about savings accumulated during your working life, we talk about pension funds. And when people think of pension funds, they think of investors in the stock market, in fixed income markets. However, pension funds also invest in the real economy. So, as most of you might know, I moved to Toronto 7 months ago, so I'm going to give you an example of downtown Toronto. All of the buildings that are blue and green are owned by Canadian pension plans. In the middle, you will see the financial district, and there almost 80% of the square footage available for lease is also owned by Canadian pension plans. But they don't only buy buildings, they also buy infrastructure, power plants. Think of ABP investing in windmill farms in the North Sea. They buy ports, telecommunication towers, and also invest in toll roads. These are not some anecdotal examples only. This is also reflected in their overall allocations. Maybe 40 to 50 years ago, pension funds were conventionally investing 60% of their portfolio in stocks and 40% in fixed income. And then with time, they started to invest in real estate, private equity, hedge funds, and these were called alternatives, given that they had a relatively small overall performance. Now, what we see clearly here from US public pension plans on the figure on the left, you'll see that the allocation has grown from approximately 10% to 30% of the overall portfolio. So calling these asset classes alternatives might not really be adequate anymore. Now, this is not only something of the US, we also observe this in the Netherlands. I think most of the people in the audience, your pension plan is ABP. ABP is investing approximately 9.5% of your allocation into real estate and 6% in infrastructure. And some Canadian pension plans invest almost 40% of their portfolio in real assets. So given that we see that people are spending a lot of their life in retirement and a lot of their financial well-being in retirement is invested in real assets, in my dissertation, I look at the allocation decisions then of pension plans towards these asset classes. How do they benchmark their performance towards the plan members? And then I shift away from the financial lens and focus a bit more on the environmental outcomes of investing in power-generating assets. So moving to the first chapter, here I look at allocation decisions towards real estate. I make use of a database called CEM, where I cover approximately 1,100 unique pension plans over a 30-year period across the globe. And with that database, I can understand these four sub-questions. The first one is the decision to enter the asset class. Pension funds that do not yet have exposure to real estate, what drives them to make this first attempt to invest in this asset class? And when they do, how do they get exposure towards real estate? Do they go for listed, private, do they do it internally or via external managers? Once they enter the asset class, I try to understand how do they set their target allocations. And then also in terms of actual allocations, I look at how capital flows go towards real estate. And lastly, I look as well at the exit decision, so whether pension funds are permanently in the asset class or also at some point decide not to allocate money there anymore. Now, what do I find? Concerning the first sub-question, I see that entry happens primarily through private markets and external managers. Now, this is particularly interesting because pension funds then don't have exposure yet and also experience investing in this asset class. So you might argue that this first attempt might go better via listed markets that for the same amount of money gives them better diversification and also access to managers that have skill in those markets. However, they go for private markets and external managers, which tends to be a lot more expensive than going for listed markets and doing it internally. Now, once they enter the asset class, what we observe in terms of the target allocations is that there's a lot of dispersion between pension plans. So taking an example here in the Netherlands, we see that the average allocation of ABP is approximately 10% towards real estate, while the one for Dutch pension fund for construction workers is close to 20%. So clearly here, it's not only about risk-return trade-offs, there's also a flavor of taste towards the asset class. What we see is that these target allocations, they exhibit return chasing. So in other words, if the asset class has performed well in the past, then the likelihood of increasing their allocation in the future goes up. And furthermore, we also see that pension funds follow their national peers. If the largest 5 pension plans increase or decrease their allocations, we see that the remaining pension plans tend to follow their direction. Lastly, looking at capital flows, what we hear in the industry is that pension funds, or there's a lot of capital moving away from different asset classes towards real estate. But actually what we observe is that a big chunk of the capital going towards the asset class is originating from the asset class itself. So it's the performance effect, namely the money that's generated on the existing portfolios, that's the money that's then being redirected again towards real estate. And then lastly, whether pension funds stick towards real estate, we see that in our sample, only 4% of the pension plans that started investing at some point also decide to step out of the asset class. So investing in real estate seems to be a very permanent decision. Now that is real estate. In chapter 3, I move towards infrastructure. And this is interesting because we see that there's a global infrastructure need of approximately 97 trillion. However, governments can finance this by themselves. We see that there's a 15 trillion financing gap, and pension funds claim or try to fill this gap by providing capital. And their argument is that the long-term stable cash flow nature, or at least the promised long-term stable cash flows of infrastructure, would be a natural match with their own liability managed pension funds. So our question is, who invests in infrastructure? How do they get exposure towards the asset class? And what are the implications for cost and returns for their plan members? Now, what we observe is that the amount of pension plans investing in infrastructure in our sample increased from approximately 12% to almost 50% of the pension funds investing in infrastructure. And furthermore, when they invest, their allocations have almost doubled from 2% to 4%. Now, what's really interesting is how they get exposure towards the asset class. You might think that they're getting exposure via investing directly, but what we observe is that private equity vehicles, so limited partnership, is up from 15% at the beginning of the sample to almost 41%. Now, this seems to contradict what I said already in the previous slide, where pension funds claim to invest in infrastructure because of the long-term stable cash flows, but they're getting exposure towards that asset class in a vehicle that only lasts approximately 10 years. And that's then not only about the stability of the cash flow, but this also has implications for costs and return. When you can invest internally, we see that for infrastructure, the average costs are 40 basis points. If you do external management, that's close to 200 basis points. Now, does this necessarily mean that they also get lower returns? No, we do see that these external managers provide higher gross returns. However, when you account for the higher fees on a net return basis, it's the same as investing internally. And in terms of scale, what we see is that for larger pension plans, they are able to decrease their cost and increase their net returns. So in terms of takeaway of investing in infrastructure, the question is whether small and mid-sized pension funds should also get exposure in a similar way as the larger pension plans. Now we're going to look at benchmarking real assets. So why do we engage in benchmarking? Pension funds allocate money from the plan members towards different asset classes. At the end of the year, they provide accountability in terms of both the performance of the asset class and a benchmark. And the idea of this benchmark is then to provide the plan members with a point of comparison to be able to distinguish what's the value added by the pension plan versus what's just in general market movements. However, as we saw before, investments in real estate and infrastructure tend to happen in private markets. They're illiquid, they're opaque. So the question is, given the increased performance of real assets in these portfolios, how are they benchmarking their real assets? What drives their choice? And also, how do they swap between these different benchmarks? Now, the first thing that we observe is that for a lot of these benchmarks, how they communicate towards plan members is not very transparent. Benchmarks are chosen and also swapped without providing a lot of information. And if you look at the benchmarks provided, sometimes it's very hard to understand whether the underlying risk strategies of their actual investments corresponds to the benchmarks chosen to compare the performance to. And when we look as well at the criteria of what is a good benchmark, One would argue that two simple criteria that you can test for is whether the returns of the portfolios are correlated with the returns of the benchmark. And this can be a proxy of whether these two are exposed to the same underlying risk factors. And what you see behind me is that the correlation for real assets, especially the ones in private markets, tend to be a lot lower than the conventional asset classes like stocks and bonds. What we also see is that some of the benchmarks that are chosen in these pension funds, they tend to be a lot easier to beat, and there's a lot of dispersion between pension plans in their ability to outperform the benchmark. Now, in terms of swapping, this is also interesting because pension funds don't only get to choose a benchmark at their own discretion, but they can also swap the benchmark without having to provide any additional information. So given the context where you have opaque markets, investing in private assets, and the ability by pension funds to swap their benchmarks at their own discretion, we set out to understand whether pension funds in this specific setting might be incentivized to choose and swap these benchmarks in order to inflate their net benchmark adjusted returns. And what we find is that there's no strong evidence of strategic selection and swapping. So to conclude this chapter, or this first part of the dissertation, we really see that there's this fog of benchmarking real assets when investing in real estate and infrastructure. Now, for my last chapter, I look at the move away from the financial lens, and I look at the environmental outcomes of investing in power-generating assets. So power-generating assets are responsible for approximately 40% of global energy-related CO2 emissions. And what we observe is that a lot of the literature right now focuses on power-generating assets and environmental outcomes in the US. Now, the figure on the right shows you the average demand for electricity across different markets across the globe. And the part that's blue, that's the part where the literature focuses on. And the part that's green, yellow, and orange, that's the gap that is still missing. So what we set out to do in this chapter is to try to understand, not only for the US, but from a global perspective, how is power-generating assets owned? Because historically, they've been owned by public institutions. Now there's increasingly more private capital. Does this lead to lower carbon intensity? And what does this imply for decarbonization paths? Now, to answer this question, we use a database that hasn't been used yet before of 139,000 unique power-generating plants across approximately 190 countries. And based on that, we aggregate the asset-level data to portfolio-level data, because pension funds, in the end, make decisions to decarbonize at the portfolio level. Now, what we find is that private ownership is associated with lower carbon emission intensity. Now, does that mean that private capital is not going towards fossil fuels? No, we do see that private capital does go toward fossil fuels. However, within that category, they focus on generation technologies that are less emitting than what is chosen by government entities. Now, when we look at the relationship for decarbonization, what we see is that especially in developed markets, there the private entities are going to decarbonize their portfolios a lot faster and a lot more than for the public entities. And when we swap that looking at the emerging markets, there we see that for private entities, for some of them even, they're going to increase their carbon intensity. So it could be that because of increased demand and also bigger population in these countries, that's why we see some of this relationship. So the question is, what have we learned? In chapter 2, we see that allocation is driven by macro conditions and also their peers, and it's not always necessarily driven by optimal portfolio choice. We see that pension plans tend to get exposure towards the asset class via private markets and external managers, and this is very expensive. It doesn't necessarily always lead to the desired returns for their plan members. In terms of infrastructure, we see that scale drives cost and returns, and there seems to be this unequal access to investment outcomes. And in chapter 4, we find that there's weak benchmarking in real assets, that performance is difficult to evaluate. And lastly, in chapter 5, we find that ownership affects emissions differently across regions, so it's not really only about public versus private, it also has to do with regulations and the different institutions within these different regions. So with that, I end my presentation and I give the floor back to the prorector.
Thank you, Alexander, for your presentation. The opposition will be opened by Dr. Dirk Brounen. He is professor of housing and household finance here at Maastricht University, and he's also chair of the assessment committee. The floor is yours.
So, thank you, prorector, for this opportunity to open this discussion, dear candidate. Let me start by complimenting you on the delivered work. The presentation was exactly 15 minutes, and it was really a joy to read your dissertation. I learned a lot. I also enjoyed reading it. I have a question, of course, and I thought maybe it's suitable to start at the first chapter with the first question. So mine is on chapter 2, and in chapter 2 we learn a lot from your analysis, and you tell us more about how do pension funds allocate, in this case to real estate, and how does this allocation vary? So you also in your presentation alluded to the fact that when they start investing in real estate, it tends to be in private mandates, and it also makes perfect sense. What was, I think, very intriguing to me is then once they are there, they will also shift their allocations over time. Maybe also they go to more listed and more blended, let's say, allocation investment styles. And at one point in time you say, well, the allocation target for, in this case, real estate, shows return-chasing behavior. And I thought, well, why is he saying this? And I think maybe the answer, but you can maybe correct me if I'm wrong, might be in the coefficients in table 2.3. Because there you also link, let's say, past real estate performances to the allocations and changes in that. So I thought, wow, this is a very interesting dissertation. I learned a lot. Now I understand more about what pension funds do, which sometimes for me is hard to understand. Then, over the last, let's say, 6 months, there has been the case of Vesteda, a Dutch residential fund, mainly owned by pension funds. And then I was thinking about that example while reading your chapter 2. And one of your promoters, it's the younger one, has been quite emotional commenting on the Vesteda case in national newspapers. And he says, this doesn't make sense. He was quite verbal on this. And I think, well, I understand him now, because he has also read chapter 2. Because if allocations are return chasing, as you conclude, then I would expect that if a fund like Vesteda is doing really well, they would get more allocation to real estate and more allocation to Vesteda. Yet, it's the opposite way around. Yeah. So they're selling off Vesteda. So can you try to help me understand, is maybe part of your dissertation wrong? Is maybe some people in APG close to me not completely coherent? Or is there a third maybe explanation for this?
Highly esteemed opponent, thank you for the kind words and the excellent question. So if I were to apply the results that I find from chapter 2, where I look at the target allocations, but also the capital flows from pension funds towards real estate, I think I can still make it fit with the example of Vesteda. So what we're seeing right now is, given the changes in tax regulation concerning the housing market, but also increasing regulations on the mid-rent market, that there seems to be some uncertainty towards that asset class in the Netherlands going forward. However, on the flip side, if we look at the past performance of the Dutch housing market over the past 7 years, you can also see that I think the returns were close to 30 to 40% over that same period. So if I use the argument of target return chasing, then over that period, you can argue they have been increasing their allocation towards the asset class because of that good performance. So on the one hand, we can argue they target rebalance. Maybe by now they're also above their target, so they take their money out again. And in terms of the capital flows, this uncertainty going forward in terms of both the tax regulations, but also in terms of the more stringent regulation in the Dutch mid-market rent market, that might explain or put the example of Vesteda in line with what I find in chapter 2.
The opposition will be continued by Dr. Alexander Andonov, who is Professor of Financial Institutions and Portfolio Management at the University of Amsterdam, and he's also a member of the Assessment Committee.
Thank you for the opportunity to ask a question. Dear Alexander, first, it's a pleasure to share the name with you, but I think we did share a lot more than that, and I think reading through your dissertation, it reminds me a lot of my prior work on the CM dataset. And I guess in this audience, I'm the one that can most relate to the effort that it takes to work with this data, to kind of understand the relations there and to examine. And I can see that you put a lot of work there. And this is a high quality work, and it's a pleasure to read it and to learn from it. Now, I have a question, and because probably I'm familiar with the topic, I came up with the questions quickly. So I would like to ask one of the paronyms to read proposition number 1 from the dissertation.
Proposition 1, fiduciary duty encourages pension funds to align their strategic asset allocations with their peers, even when differences in pension fund size, maturity, or constraints would justify distinct portfolios.
Thank you. And now I would move to chapter 1, page 1, footnote 1. It's all about 1. And this footnote says, fiduciary duty refers to the legal and ethical obligation of pension fund managers to act solely in the best interest of plan participants and beneficiaries. It continues to say at the end that pension funds are uniquely and explicitly bound by law to prioritize the retirement security of their participants above all other considerations. So my question is, going back, if we read these statements about fiduciary duty, why does it encourage herding and kind of looking at what the peers are doing? There is nothing in these legal statements that is about herding and looking at peers. Is it about fiduciary duty? Or is it about career concerns, weak skills, or weak incentives of pension board members? What is driving the networking effects or herding behavior beyond kind of taking into account pension characteristics?
Highly esteemed opponent, thank you for the kind words and also for the question. I think indeed this is a very good point. So what I start off in chapter 1 by saying is that pension funds should act according to their fiduciary duty, which is always in the best interest of their plan members. However, what we observe, and the reason why I come up with this proposition, is that I see in both chapter 2 and chapter 3 that pension funds seem to copy each other's behaviors, even though we also know from the literature that given their own characteristics, they might have to construct a different type of portfolio. So maybe indeed, how I should have framed the proposition 1, is that indeed it's not necessarily due to fiduciary duty, but the pressure of deviating from other pension plans incentivizes board members to copy their behavior. And why is that? That's because of the pressure of fiduciary duty. If I take a portfolio allocation that differs widely from everyone else in the same country, if it goes well, that's great for me. If it doesn't go well, then they ask me, what were you doing? So the incentive of having to comply or explain, in this case, I would say forces or incentivizes pension plans to follow national peers under the name of fiduciary duty.
And do you see any evidence in your research and work that better governance, think about, let's say, having more experienced, more skilled board members or board members whose incentives are more aligned with the characteristics of the pension plan, helps avoid this trap of herding where too much herding, let's put it.
So in my own chapters, I use the data on board composition in chapter 4 on benchmarking. And there I try to see whether the board composition has any impact on agency issues. I don't find that. But I do know of other literature, amongst which your own, where you do find that the board composition, and especially differentiating between those elected by the state and those that actually have experience, does play a very big role in avoiding these agency issues.
Okay, thank you.
The opposition will be continued by Dr. Monique Donders, who's country manager BlackRock Netherlands and also member of the assessment committee.
Thank you. Dear candidate, let me compliment you on a broad study of a very relevant asset classes using a very comprehensive data set. So work well done. My question is on chapter 8, so the very last part of your dissertation, where you reflect on potential future work. And you mentioned data centers as an emerging sub-asset class. And you state that we need to better understand financial and environmental characteristics, such as how they support local communities by economic activity and energy use and carbon footprint. This is indeed a very relevant topic for future research when new data emerge. My invitation would be to broaden that scope of that future research, because the rise of data centers and hyperscalers is ultimately driven by the development of AI. And AI is one of the most profound structural changes that have a major impact on investing by shaping economic trends and asset performance. So my question is, how do you see AI influence other sub-asset classes, both the more emerging ones, such as logistics and life sciences, as well as the more traditional ones, such as offices? Specifically, what do you see as an investment rationale, given the development of AI and the main risks in the context of building institutional portfolios?
Highly esteemed opponent, thank you for the kind words and the question. That's a good point. So if we look historically, pension funds have allocated primarily to offices and residential, and we see that their portfolio construction is shifting more towards alternatives within real estate, and one of them being data centers. I think your first question is, how will AI impact the performance or portfolio construction of pension funds concerning these asset classes? I think from a pension fund's perspective that they're focusing on building a portfolio that meets their liability demands. So if within the real estate context, pension funds feel that the demand for offices or other more conventional asset classes is not really there, that they move towards these alternatives, that this is good. From an AI perspective, I think still most of these asset classes are in private markets where data availability is not always as available. The data is not as available for the pension plan. So I think using AI to construct a portfolio just using risk-return optimization is not really going to be the future.
That is not what I meant. So my focus would not be on how AI can help build portfolios, but how AI would influence sub-asset classes, such as offices, maybe more remote working, maybe less working due to increases in productivity, for example, and how that would change the relative attractiveness or the relative risk profile of different sub-asset classes.
Okay, so thank you for the clarification. I think indeed, let's say if we focus on offices to start off with that, maybe with the introduction of a lot more AI softwares, you can argue that people will work from home. They won't go to the office as much. So maybe then it's not that you don't need offices anymore, but you will use them in a different way. Now also with the demand or the increase of AI, there's also going to be demand of different types of real estate. The one you mentioned first was, for example, data centers. In that specific aspect, you would argue that if the economy is more dependent on AI, then investing in these sub-asset classes might be a good idea for pension plans, but I think as with any other market, you need to know which assets to buy. Maybe in terms of operations of the asset classes, AI can help to lower costs, be more efficient, where some overhead costs can be removed away.
Thank you.
The opposition will be continued by Dr. Roger Otte, who is Assistant Professor of Finance here at Maastricht University, and he's also a member of the Assessment Committee.
Thank you, Pro-Rector. Dear candidate, dear Alexander, congratulations on your thesis. I had the pleasure to witness your journey, which started as a teacher in my course, and later on you worked alongside me at ABP for half a year, and I see a lot of that experience being reflected in your thesis, so well done. Now my question, and it's about Chapter 5. In Chapter 5, you document that ownership determines emission trajectory. You admit also in the thesis that it's correlational instead of causal. So for me, there remains the identification issue. So specifically, my question would be, how would you causally distinguish between whether governments actually actively retain strategic power assets, which pollute more, versus private owners self-selecting out? Can you think about an exogenous shock to instrument ownership? I look forward to your answer.
Highly esteemed opponent, thank you for your question, and also thank you for the kind words. I indeed also enjoyed having you as a course coordinator and working with you at ABP. I think this thesis would have looked completely different if I did not have that experience 2-3 years ago. So thank you very much. You're right. So chapter 5, what we really struggled with is having some type of real proper causal analysis. In terms of brainstorming, so what we have in terms of the data is we see ownership in the cross-section, and then we can see also forecasted capacity in the year up until the year 2029. And based on that, we construct these decarbonization paths at the portfolio level. Ideally, what we would like is to have indeed an external shock and also some time series observation where we can say, due to this external shock, maybe there's been some forced divestments, and using that, we can identify whether the decarbonization is really then causal or correlational. Maybe one that we can use is the energy price hike in 2021 as an energy shock. So that's also what we try to do with the data. So we contacted the data provider to see whether we can get the ownership before 2021 and compare that with what's happening after. That wasn't possible. Maybe now as well with the current war, maybe that could be an example of an exogenous shock, geopolitical shock that happens that forces some divestments of some assets, and maybe that's something we can use for a more causal analysis.
What about carbon pricing? I guess that, of course, be the ideal one.
True. Yes, so do you mean then specific regulation implemented on carbon pricing, for example, in Europe? Yes. That's a good point. I didn't think of that. That's something that definitely, I think, could be used. I think the lens I took before in the paper was trying to find a shock that was more global. And then these energy shocks, or for example, the war happening right now would have been a good event to use. But I think indeed that's a good exercise that I could look into.
Okay, thank you.
Thank you.
The opposition will be continued by Dr. Stani Milcheva, who is professor in real estate finance at the University College in London. The floor is yours.
Dear candidate, it was great to read your dissertation, and I appreciate you working on real assets. I know how challenging it can be in terms of data access and also turning it into like a publishable research with lots of data gaps. So it's really great to see how you circumvented this problem. And it's super interesting what you have done so far, and I hope you continue doing research in this field. I have a question on chapter 4, the benchmarking chapter. So you use this international CEM database, of which I'm not familiar with, and you show how pension funds set their bar, so choose their benchmark when it comes to real assets. And I think the more interesting bit is as well how infrastructure is benchmarked, because there's so few benchmarks and the asset is so heterogeneous. So you also link that to the cross-sectional dimension, so how funds differ in the choice of these two types of benchmarks, absolute versus relative. So maybe you can say a little bit more about how the choice of benchmark affects, first why it affects fund performance, like what's the logic, and then how, and do some types of benchmark lead to weaker performance and why? What are kind of the key takeaways when it comes to benchmarking real assets and infrastructure assets in terms of the choice of benchmarks?
Highly esteemed opponent, thank you for the question and the kind words. So when we're looking at real assets, I think the question is not, or maybe to the first question, it was focusing on infrastructure. So we know that there's a lot of capital going towards real estate already for 30 years. So also in terms of the index providers and data availability, there's a lot more clear market indices that are standardized and accepted by the market that can be used. Now, if infrastructure is only now really becoming mature and institutionalized, then a lot of these market-ready indices are simply not available for pension plans. So what we observe in the data is that in the earlier years, pension funds used to combine benchmarks from, for example, listed equity and fixed income, arguing that these would represent, to some extent, the similar risk characteristics of infrastructure. And now, over time, we see, for example, Clio, EDEC Infra, that they are now also providing more standardized benchmarks for these pension funds to use. So I think for your second question, looking at the choice of benchmark, I think one of the key determinants is, of course, what is readily available, what can they use? And what we observe in chapter 4 is that especially for the emerging asset classes, so private infrastructure, natural resources, there the likelihood of choosing an absolute benchmark, that means a benchmark that's not tracking the market, is a lot higher than for the more established asset classes like private real estate, but also for the listed alternatives like commodities and REITs. So I think it's a combination of both trying to find a proper benchmark and that benchmark simply not being available. Now your third question, was looking at performance. And I think your question was, how does the choice of benchmark impact performance? And I think it's slightly different. Namely, pension funds, in my opinion, don't choose the benchmark for their performance. They choose a benchmark that should reflect what their investment strategy is. Now, we do look at the impact of benchmark changes on performance, but we take the lens of pension funds might feel that their actual portfolio might not do so well, so they're going to swap their benchmark so that their net benchmark adjusted performance is unaffected or at least or might even be increased. And we don't find any consistent evidence of this. So I think for the final question, it's not that the benchmark choice affects performance directly. If anything, you change your strategy, and as a result, you change your benchmark, and that might be reflected in the performance. But the benchmark on its own does not change your performance. You might swap it around so that your net benchmark adjusted return looks well, but like I said, we don't find evidence for that.
Thank you.
Thank you.
The opposition will be continued by Dr. Onno Steenbeek, who is Professor of Institutional Asset Management at Tilburg University.
Dear candidate, dear Alexander, I first would like to echo all the kind words that were spoken by the other committee members. Readable, thorough, timely, very relevant thesis, so congratulations on that. As you know, I'm a big fan of the country that you are from. For the warmth of the climate, but maybe more importantly, the warmth of the people that live there, of which you are obviously a prime example. And therefore, it probably is not a surprise that I will ask a question on Proposition 5. And maybe one of your kind assistants can read it out.
Government and central bank mandates that require Curaçao pension funds to allocate capital domestically conflict with their fiduciary duty to beneficiaries and should be abolished.
Okay. So I have sympathy for this statement. But in a World Bank paper I recently co-authored, we used Curaçao as an example, not as a cautionary tale, but as a relative success story. So the Algemene Pensioenfonds Curaçao, APC, and Vida Nova, they invest about 40 to 50% of their assets locally in cruise infrastructure, wind farms, housing, and they still meet fiduciary standards. Maybe more importantly, the central bank's domestic allocation guideline has become more flexible over time. So they have developed the governance capacity to evaluate local projects on commercial terms. Now, this raises a question about causality. So if the mandate itself is the problem, is the mandate itself the problem, or is it the absence of the governance infrastructure that would make domestic investment fiduciary compatible, right? So put in a different way, without the mandate, would APC and Vida Nova have developed the local expertise, the project pipeline, governance structures they now have, or would they simply have diversified internationally and thereby leave Curaçao's necessary development financing needs unmet? How do you view that?
Highly esteemed opponent, thank you for the question and the kind words. Maybe as a motivation why I chose this proposition is that we know that there's three main pillars in a pension system. So the first one being in the Dutch system, the AOW, the state-sponsored one. Then you have pension funds, and then the actual savings of the individuals. Now, I have some people here from Curaçao in the front row, and I think most of us can tell you that the average payout of the first pillar is approximately 800 guilders. Now, with that, you can't pay your rent, water, electricity, or food. So from that perspective, the second pillar, pension funds, they really have to do a great job for the plan participants. Now, if I look at the size of, for example, APC, it's a really, really big pension plan. So they are being mandated by the government to invest almost 50% of their portfolio locally. Now, before I heard your story, I haven't read the paper yet, but if I compare that same scenario with different countries, I would say, for example, if I take the Netherlands, you can invest still within one country, but have exposure to different regions, different sectors, different economic demands. While on a small island like Curaçao with approximately 160,000 people, and our economy solely drives on tourism, then having 50% of your portfolio in the local market is not necessarily something I would say is safe for the plan participants. And as an example for that, I will take the COVID crisis that happened a few years ago, where if you look at the investments that were happening on the island, were mostly in the tourism sector. Even the ones in real estate, their tenants were tourism agencies. So with that in mind, and also we don't have a stock market, there's not really any trading happening on the island. Most of the allocation on the island happens in fixed income, government, or real estate. So in terms of the fiduciary duty, I think it would be better than to diversify away from Curaçao and also invest in different markets. And of course, if there are good opportunities and they have the local expertise, great. But being mandated to invest 50% of your portfolio locally when capital markets are global, I would say is not something that's efficient for, given their fiduciary duty.
Okay, but would APC and Vidanova have developed any expertise to evaluate even the good opportunities that there are, had there not been a mandate? So they could just have put it in US stocks and maybe Dutch windmills or whatever.
Yeah, I don't see why not. So I would say that they have consultants and external managers that might provide them with good investment opportunities, but they also follow the local news, they know the local people, they know the local market. Yeah. So I think with time, that might have incentivized their knowledge in the local markets.
Okay, thank you.
Thank you.
The opposition will be continued by Dr. Rachel Pauno, who is Professor of Art Finance here at Maastricht University.
Thank you very much. Dear candidate, dear Alexander, your PhD was a real pleasure to read. You not only write really well, but the data sets that you've obviously used, as Alex alluded to, and your in-house expertise from APG gave you such an opportunity, and it's a real credit to your dedication and the commitment to your research. So congratulations. Also on having 2 publications that you cite in the bibliography, which is really nice with your supervisors. It's not so often the case, but it shows how dedicated you really are as well to your research. Your dissertation and the symposium today surround the topics that you've been working on, sparked actually a lot of thoughts as well, from the relative growth of real estate and the phenomenal growth in the housing market, or otherwise said, the relative underperformance of traditional assets and the importance of pension funds and other institutional investors in taking the lead in driving infrastructure investment. And above all, the opportunities that those institutional investors, including the pension funds, that they have in determining the role that is played in the future. So how we adapt to the future is key. And that's in the parlance of our new institute, which we have here in the department, Institution for Adaptation, which some of us here belong to today. But what I see is a lack of agility due to resistance, sometimes from board members, not willing to take risks. Also that inability to shirk perhaps from the fiduciary responsibility for more social impact, because we see this trade-off for long-term impact for, say, more housing or better infrastructure. Again, a topic reflected in today's symposium. And it should be perhaps more prioritized that we have a focus on the retirement security of the future and that focus on that long term above all in the fiduciary duty, which which also was alluded to in footnote 1. This takes me to chapter 5 for the question. And here I was surprised actually to see in table 5.3 such a strong tilt towards the fossil fuel technologies for institutional investors. And given the importance that institutional investors, and as I say, pension funds therefore are playing in such a role to adapt to the future, we see this odds ratio here of 8.41. That basically means that you have 8 times the odds, of course, that the assets owned relative to the government. So that either says something about the government as much as it actually does about the institutional investors themselves. And my question, therefore, is that the public sector is key in driving this change towards renewables. But when I see such a high odds ratio and then such an insignificant nuclear findings in the final column of the table, I'm interested to understand what's driving either the very high or the very low significance in nuclear relative to also the fossil fuels.
Hi, esteemed opponent. Thank you for the question and the kind words. So first of all, maybe let me focus on the nuclear part. We do cover a big chunk of the power generating assets globally, but if you look at the sample that we have for nuclear, it's a lot smaller than that for the others, so renewables and fossils. And also, we're looking at cross-country differences, so we're comparing to the US. So here as well, we see that there's a lot of concentration in some countries that have a lot of nuclear and others that don't, so that might drive the result for nuclear. Then your other question was for the fossil fuel ones, why we see that for private entities, they are more likely to go in fossil or...
Why the odds is so much higher for a ratio of 8, or 800% effectively, or 8.4%, yeah. 840%. And implicitly, what effect does this have then for society in large, given that you have institutional investors playing such an important role? And if they have, therefore, such a high odds ratio here towards fossil fuels, how can you effectively change society? What would be your implication from these results?
So maybe one first thing I can also add here is that we're looking at the portfolio compositions of these private entities as is. Right? So on the one hand, it could also be that to provide additional capacity, electricity capacity, they're entering into markets that might be simply easier, less risky, also in terms of regulation. So if we compare to, for example, now the US, where the previous president enacted the Inflation Reduction Act, capital went towards renewables, and now the current president is taking that away. So maybe that's also a bit of the hesitation from institutional investors, that they don't go into renewables, but they prefer maybe the more stability of some of the fossils. But of course, on the flip side, you also have the risk of transition risk and stranded assets. So to explain exactly why it's eight times higher, I don't know, but I think definitely we see more ownership of fossil, but we also see higher decarbonization. So maybe that can reconcile in saying their capital is going towards these asset classes, but they're putting in also a lot of effort to make them more efficient, to lower carbon intensity.
Thank you. Does that probably also help explain in figure 5.2 then following why you have then in panel C the very, very low effects for nuclear, whereas you, kind of odd results relative to the others on renewables and ownership? Because it's on the country interactions with the ownership, it's also relative to the US, right?
Which table, sorry, that was?
Figure 5.2, so the graphs that you have for panel A, B, and C on page 163.
Yes.
Yeah.
Yes.
Okay, thank you.
Thank you.
So this concludes the first round of questioning. Now we have 3 members in the committee who have a question related to proposition number 6, and I invite Dr. Brownen to start with the question.
Yeah, thank you, Mr. Prorector, and Alexander, welcome to round 2, which tends to always to be a little bit more emotional and complex. So maybe we can start round 2 with your paronym from Denmark to read it out loud. Number 6. please. Yeah.
English, huh?
In English, please, yes.
As academics, our societal impact is determined more by the quality of our teaching than by the quantity of our publications.
Yes. So completely independent from each other, Roger Otte, Rachel Campbell, and I wrote down that we would like to discuss this with you today. And there were different opinions. So again, I don't want to point names or fingers, but one member of your promoter team, it's a slightly older one, he says, yeah, this is completely correct. This is completely correct. And then his rationale, and I tend to agree mostly with this person, but now I'm still in doubt. He says, well, the median number of citations of a publication academically is 1 or 2, and we always have more than 1 or 2 students in our course. Well, that might be true, but I have to remind your promoter team that if you add their citations together of the 2, it's more than 25,000. And although they do a lot of teaching, maybe it feels like a lot, it's not more than 25,000 students they have taught in the last, let's say, 37 years, to be exact. So I'm not convinced completely. So is indeed our societal impact not always also very powerful? Let's say with academic research, I will be teaching, last year we did it together, you and I, a course in 2 weeks, and I will have 56 students.
Yeah.
So you have 4 chapters. Chapter 3 has been published. So you have 3 more opportunities. Which one of those remaining 3 chapters you think has the highest potential of societal impact? Why? And how could you maximize that?
Hi, esteemed opponent. Thank you for the question. So actually, if my answer would be still on chapter 4. I think pension funds play such a big role in society in providing retirement security for millions of people. And I think a big role or a big component of their task is also providing transparency toward their plan members. And chapter 4, especially with now additional information that we're gathering and analysis to extend on this chapter, I think really adds value or impact in terms of informing plan members better. First of all, in terms of risk strategy, how is their money being invested, and also provides them more information in terms of value add by the pension plan as a financial intermediary. Thank you.
So I would like to invite Dr. Otte to add.
Thank you. Yeah, so the next question on the same proposition, so I'm not going to ask the Paranymph to read out the same proposition, but a slightly, let's say, alternative way of asking that. So my question is there a causal relationship between teaching and research? So does a great researcher teach better, or is it the other way around? How would you test for that, and what will you expect as an outcome?
Highly esteemed opponent, thank you for the question. I think good research or a good researcher is someone that's very rigorous, is very ambitious about a certain topic, and that tends to be correlated with also being motivated in teaching your students. So I think a good researcher is very likely to be a good teacher. But I think in terms of what it means to be a good teacher, it's not necessarily a skill set. It's, I think, in my opinion, a choice. So it just takes a lot of effort and preparation and actual willingness to transfer knowledge that you might have to the students. Yeah, to test that causally, I would I think it's very difficult, because I would say the impact of a researcher on students is not necessarily only on outcomes in terms of getting a job or having a high salary. I think a big part of it is also maybe the inspirational speech or lecture that you gave, or motivating your students to do a bit better. Maybe they entered a course and they didn't want to take it, and now they're really excited to do finance or whatever that may be. And I think to quantify that impact is just very difficult. Yeah.
Thank you.
Dr. Pauwel.
So yeah, to build on this, it was interesting that we all came up with a very similar approach, but a different, slightly different. I was triggered in a very different way about the same proposition. Yeah, clearly education is highly important, yet your proposition potentially ignores the interaction effect that you may have between the quality and the quantity of research in education. So although I agree with the tone of the argument, it is also really important to think about the impact of research when you're teaching, for example. And here we have the Maastricht Centre of Real Estate as an excellent example of the quality of teaching is actually a function also of the quantity and quality of the publications of those sitting around us. So how would it be actually fair then to say that your teaching quality may also have improved, including your PhD today, by being able to use your societal impact of your own articles? You clearly show your passion and your wisdom that it exudes when you're sharing that knowledge. And would you not think that it also then enhances the learning environment and therefore could result in effectively a larger societal impact than perhaps before?
Sure. I think delving into these topics deeper, working on them for so long, seeing the results, writing the literature, that also motivates you when you're either giving a lecture or sitting in a tutorial, and thus makes your education better. Maybe to all three of you, to the lens through which I wrote this was that sometimes I feel in academia there seems to be this burden on teaching, where people think, teaching is very boring. And I always think that in addition to the research that we do, there should also be a lot of attention and motivation towards education and also teaching the students that come in front of us.
Thank you.
I would like to invite Dr. Andonov to proceed the opposition.
Thank you. I will not ask a question about Proposition 6. I will go back to more conventional rigor findings from your dissertation. One of the most exciting results you have there is that in real estate, which we still tend to think of as a growing alternative asset class, the net capital flows are generally small and often negative, especially in the US and Europe. Pension funds typically withdraw capital following strong returns, which is consistent with rebalancing towards your strategic weights. And what is even more interesting is that pension funds systematically reduce allocations when they're over-allocated relative to their targets. So this makes me concerned, because a lot of these assets relative to targets, they paint on NAV valuations, which are not the best thing in the world. Not the most precise thing in the world. And can you comment a little bit, what is the role of NAVs in this process? Should real estate funds be concerned about it? And second, how are these withdrawals executed? Is it enough, the dividend payments, or do you observe, or do you think also about sales, liquidation of stakes in closed private equity funds, or withdrawals, redemption requests to open-end funds, etc.? How is this executed in practice, what you find on a high aggregate level?
Highly esteemed opponent, thank you for the question. I think there is an issue with NAV values with real estate in private markets. In terms of these capital distributions, so we try to split it up between fresh capital added towards the asset class and the capital that originates from the existing portfolio. And the magnitude of these flows that we observe cannot solely be due to distributions. There must be also some liquidations happening in that case. So take an example of the question of highly esteemed opponent on Vesteda.
Great case.
I think in some cases as well, they're just they're exiting some other assets directly. So I think it's a combination of both of these components.
Thank you.
Please briefly take time to finalize the answer to the question.
So I think the combination of both distributions and liquidation of the asset class, that's what we observe at the aggregate level. So at CEM data, we can't observe the actual assets and vehicles that they enter. However, what we can observe is the total portfolio movements. And like I said, the magnitude of these capital flows can't solely be due to distributions. It's also part of liquidations.
Alexander Carlo, the time appointed for defending your thesis has passed. The degree committee will now withdraw to discuss the quality of your thesis and your defense. I request that you and your company await the results of our deliberations and our return in this room. Alexander Carlo, the degree committee here present has assessed the quality of your thesis and your defense. In view of its positive verdict, and taking into account your previous qualifications, the degree committee has decided to grant you the degree of doctor. Professor Eichholz is authorized to confer upon you this academic distinction in accordance with Dutch university custom. I invite your supervisor to now take the floor.
Belooft u dat u altijd volgens de beginselen van wetenschappelijke integriteit te werk zult gaan? Eerlijk en zorgvuldig, transparant, onafhankelijk en verantwoordelijk.
Dat beloof ik.
Krachtens de bevoegdheid ons door de wet toegekend, volgens het besluit van de commissie hier tegenwoordig, verklaar ik u, Alexander Phillip Eduard Carlo, tot dokter te bevorderen en u alle rechten te verlenen die daaraan volgens wet en gewoonte zijn verbonden. Ten bewijze hiervan overhandig ik u nu de bul, door rector, secretaris en de overige leden van de promotiecommissie ondertekend en met het grootzegel van de universiteit bevestigd. En nou is het druk dat we hem niet laten vallen, want dat gebeurt wel eens. Er zijn kandidaten, ja. Oké, Alexander. Without a doubt, we can say that Alexander is the most popular and most beloved colleague in this department. There's no doubt about it. He left now, and that really creates a gap. And after 13 years here in Maastricht, and not in the beginning at the department, but out of the 13 years, I guess 10 years in the department, you have become one of the veterans of the department, really part of the family, and Maastricht and this department have become your second home. And we really felt it, and I know you feel it too. And we talked about it yesterday over coffee. You had the emotion to come back is really, really a very good thing. So that is mutual love between the department and you. Now, who is Alexander? We all know him, but I still want to talk about it a bit. Of course, he's the positive, good-humored, always smiling guy that we all know. Very, very like the 100% likable guy. Unbelievable. But that's one. Second, I think even more characteristic is always so incredibly well prepared. And so Dirk was already alluding to it in the when we just at the end of your talk. You spent exactly 15 minutes on it. I think 15 minutes minus 2 seconds or something. So that's really, really well prepared. And then also, if you look at the way you handled the question, it was boom, 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 boom. So it was Stani was saying it was as if he knew all the questions already. And of course you didn't, but that's the way you were prepared. Your talk this morning also, great slides, great tempo, great question handling. Again, preparation. And I know that when course coordinators wanted somebody to help them with teaching a course, we have great people to do that. But Alexander was always very popular there as well, because as a course coordinator, you always know, or knew, because he's no longer doing it, unfortunately, that with Alexander on your side, you could sleep soundly. Because if Alexander said, I'm going to do this, it would be done. And it would not just be done half-heartedly, or no, it would be done perfectly. So that's also, so you knew as a course coordinator that you could bring your course to like an evaluation level of 8 or something. But with Alexander on board, you could go to 9, 9.5. And of course, we all want high evaluation, so people fought really for Alexander. But then, you know, he taught my course. Yeah, that's how things go. So I was teaching this bachelor course, Financing Emerging Markets, and I needed emerging market credibility because obviously I'm from Bloemendaal. You can't really say that's an emerging market. Yeah, well, submerging maybe. So, but not emerging. And this guy's from Curaçao. I mean, that's totally emerging. So I really wanted Alexander, and it really was perfect. I think we taught the course together for 5 or 6 years or something. It was a fantastic experience, and we always were very, very highly evaluated. Then another thing where his preparation and his professionalism really shone through was our organization of the Curaçao International Conference of the American Real Estate and Urban Economics Association. And I can't stress enough what a milestone this is for your career, because many academics never do that, organize a conference like as prestigious as that, because they're afraid of it and they think it's too much work and blah, blah, blah. And we raised the idea, let's do it. And from the beginning we said, okay, we're going to do this, but you're going to do most of the work. And this is in his PhD. And the PhD, most PhD students say, yeah, well, it's just 4 years. I can't do this because, you know, I've got just 4 years and I'm going to be in time trouble. You said, yes, I'm going to do this. And you really performed. This conference was absolutely a highlight, I think. If you look at all the international Aruya conferences, this was one of the top conferences, both in terms of content, but also in terms of mobilizing the local real estate community was unique. We never have local real estate brokers or advisors visiting these academic conferences. And now they were all here. It was fantastic. So all you. Then a further characteristic of Alexander is he's a real family man. So when his mother got sick during the PhD, there was no doubt. Alexander said, you know, guys, you didn't actually call, you said it. I'm going to Curaçao, I have to be with my mom, and you went, and then until everything was stabilized, you stayed there. It was fine, so that shows you what kind of person you are. But also, again, yesterday, we talked about Toronto and Canada and staying in Canada, and he said, well, I want to stay there because it's in the same time zone as Curaçao. Okay, great. Great argument. And so that's the argument of a family man, right? Okay, now, and then always ready for adventure, cat sailing, improv theater, going to Toronto, a place where the guy knows nobody, no problemo. So that is also really good. Now, and then lastly, the move from best teacher to PhD student. In the beginning, you were playing a bit hard to get. So I said, well, I think you should be a PhD student. And then I didn't hear anything for months. So I was talking to Stefan, for example. Does he really want to do it? And Stefan says, yeah, I think he does. But okay, that turned out fine. And that also has been a great success. Fantastic dissertation, awesome defense. Stay in Florida with David Ling. David Ling is, I know, very fond of you. And there's a great paper coming out of that. The internship at ABP, thanks to Roger. One of the reasons I think this dissertation is so practically relevant is that they told you what practical relevance is and what the key issues are in pension investing, and you really see it reflected in the quality of the dissertation. And last, maybe the teaching that you did at at Curaçao for the pension funds over there. That was also a great success. I think it would be a great idea to do it again, to develop more of that together with Onno, not just because it's fun, but also, again, for impact, because you really have something to say. And I know you want to have impact for Curaçao, hey, where you grew up. I think it's a great idea. And then, okay, then the question is, what is the next step? Well, probably next step is staying in Toronto or Greater Canada, maybe Montreal, depends a bit. But also, I really see a career as Minister-President of Curaçao. Or the CIO or CEO of APC. Why not? Because I see such incredible dedication and professionalism in you. I really think the sky's the limit and everything is possible. So Alexander, you deserve it. Congratulations.
Dear Dr. Carlo, also on behalf of Maastricht University, I congratulate you with the degree you have acquired. So after I have finished this session, I would like to invite you, your parents and your family to join us, the Corona, outside, where we will take some pictures on the stairs. And after we have left, I would like to ask the audience already to go to the Refter, where we will join you afterwards. I hereby close this academic session.